Hello everyone and welcome back to another video. In today's video, I want to go through some of the biggest earnings reports that came out over the past week, which includes Google, Netflix, and Tesla. Then I also want to talk about my thoughts on some of the meme stocks that have been running really hot again, and showing you some of the kind of froth that I have been seeing in the market. Then we will get into an update with Mercado Libre because some pretty bullish news came out over the past week as well. And lastly, I want to answer a couple of really good questions that I got from my audience on one of my previous videos that I didn't get around to in my last video. These are a couple of questions that I think add a lot of value to the community as a whole. So I want to give you guys my answers and answer them publicly. So this is going to be another action-packed video. So let's just hop right into it and get started with Google's earnings. And as always, I went through the earnings report and I took some screenshots of all of the highlights that I found. So here are Google's earnings highlights. Consolidated revenues grew 14% year over year. Google services revenues increased by 12% to 82.5 billion. Google Cloud revenues increased by 32% to 13.6 billion. Total operating income increased by 14% and operating margin was flat at 32.4%. Net income increased by 19% and earnings per share increased by 22%. Then the CEO said, "We had another standout quarter with robust growth across the company. We are leading at the frontier of AI and shipping at an incredible pace. Cloud had strong growth in revenues, backlog, and profitability. Its annual revenue run rate is now more than $50 billion. With this strong growth and growing demand for our cloud products and services, we are increasing our investment in capital expenditures in 2025 to approximately $85 billion, and we are excited by the opportunity ahead." So overall, it looks like Google had a really strong second quarter with a net of 14% revenue growth across the entire company. Google Cloud revenue is actually accelerating right now, and it looks like due to Google Cloud seeing an acceleration of growth and continued strong demand, Google is increasing its CapEx outlook for 2025 to $85 billion. And I think that initially investors were turned off by this because Google stock dropped by about 3% in after-hours trading after they reported their earnings. And I think that this is partly why, because obviously CapEx is investments in future growth and it does subdue cash flow in the short term. And a lot of people are skeptical if this massive CapEx is going to play out. But let's continue on through my screenshots. And this next one shows us the different segments of Google's business and the revenue growth for all of them. So here we can see that Google search and other revenue is up 11%, YouTube advertising revenue is up 12%, and advertising as a whole is up 10%. Subscriptions revenue is up 20%, and Google Cloud revenue is up 32%. Other bets revenue is flat, and overall revenue was up 14%. So many of Google's different business segments are growing above 10% year over year, which does seem pretty bullish because there is this overall sentiment right now that Google's business is being disrupted by ChatGPT and Perplexity, but the numbers show that Google's business is still performing quite well, and certain business segments are accelerating, especially with Google Cloud. So overall, so far, this does look like a pretty dang good earnings report in my opinion. So let's move on to the next screenshot now, which is their different segments operating income. And we can see that Google Services operating income came in at $33 billion, which is up 11% year over year. And Google Cloud's operating income came in at $2.8 billion, which is up something like 160% year over year. So Google Cloud is becoming highly profitable, its margins are expanding, and its revenue is up 32% and accelerating. So Google Cloud was really the standout for me in this quarter, and this business is just performing incredibly well. And it seems like the margins are only going to continue expanding with the overall revenue as well. So yeah, Google Cloud is just killing it. It's actually adding to Google's overall profitability now. And it's accelerating Google's profitability, which is great to see. All right, now let's move on to the cash flow statement. And I think that this was another point of contention for investors this quarter. Because right away, if we take a look at the operating cash flows, they came in at $27.7 billion for this quarter, which was only up about $1 billion year over year, or about 5%. And I saw a few investors on social media saying, well, the operating cash flows are hardly up year over year, so Google's operating profits aren't really growing. So at face value, this doesn't look that bullish, but you have to take a look into what is going on with the operating cash flows. And the main difference year over year was Google's income taxes on a net basis. So last year in the second quarter, they paid $3.9 billion of income taxes. And in the second quarter of this year, they paid $9.6 billion. So there was an increase of about $5.7 billion year over year for income taxes paid in the second quarter, which is subduing operating cash flows massively this year, whereas last year, operating cash flows were not impacted nearly as much. And if we take a look at a year-to-date basis, we can see that Google's operating cash flows came in at around $64 billion versus $55.5 billion last year. And year-to-date, the income taxes have a difference of about $1.6 billion, so they are more leveled out on a year-to-date basis. So therefore, I think that the year-to-date operating cash flows give us a better indicator as to the overall growth of Google's operating profits, and it is up about 15%. So again, you do kind of have to dig into the numbers a little bit more and take a look to see if there are one-time impacts on a quarter-to-quarter basis as to why the operating cash flows may not be growing as much on a year-over-year basis. Now, with that being said, we can see that Google's capital expenditures, or its purchases of property, plant, and equipment, are up massively year over year to $22.4 billion versus $13.2 billion last year. So Google is clearly continuing to invest more and more money into capital expenditures this year, and this has caused their free cash flow on the quarter to only be $5 billion versus about $13.5 billion last year. So Google's free cash flow actually declined on a year-over-year basis as well, due to them investing so much money into CapEx. Year to date, we can also see that Google spent about $40 billion on CapEx so far. Now, what's interesting is Google had about $5 billion in free cash flow this quarter. However, they repurchased $13.6 billion of stock, and they paid $2.5 billion in dividends. This is about $16.1 billion returned to shareholders through buybacks and dividends, at the same time as the business only generated $5 billion in free cash flows. And how the company afforded to pay out this much to shareholders was they issued about $26.8 billion of debt, and they repaid about $13.8 billion of debt. So they raised about $13 billion of debt on the quarter, and they very clearly used this debt to buy back stock because they're not producing that much free cash flow in the quarter. So just taking a look at the cash flow statement, I think it's pretty clear that Google is officially taking on some debt, leveraging up its balance sheet a little bit to buy back stock. In my opinion, I do not love to see this. It's not really ideal, but it's not black or white. And with investing, pretty much everything is subjective and nothing is black and white. And what I mean by that is, let's say that Google could get debt at 1% interest rates and its stock was selling for 10 times cash flows or offering a 10% free cash flow yield. In that situation, it would actually make sense to leverage up the balance sheet quite a bit and deploy that capital into buying back stock, because you're getting a much higher return on your invested capital by deploying it into the stock at a 10% free cash flow yield. If your cost of capital is 1%, you're basically getting a 9% yield there, a net of 9%. So it can make sense to do this. But in my opinion, with interest rates around 5% right now, and with Google's stock selling for around 20 times operating cash flows, there's not really that much of an arbitrage here. So why I think Google is spending money to buy back shares like this is because they are doing a lot of stock-based compensation. In my opinion, stock-based compensation is a very real expense because it dilutes shareholders, and companies have to buy back shares just to offset the dilution from stock-based compensation. Now, Google is buying back more than they're doing in stock-based compensation, so the share count is net declining. But I still think that Google would be buying back shares no matter what to offset stock-based compensation, which also very clearly suggests that stock-based compensation is a real expense for the shareholders. And that's just my opinion. So it is kind of weird to see that Google is leveraging up the balance sheet to do this. It can make sense in some scenarios, but in this scenario, I don't think that it's really doing much for shareholders. Now, with all that being said, let's head over to Stock Unlock and take a look at some of Google's metrics now. So here we can see their trailing 12 months revenue growth over time. And we can very clearly see that Google is hitting a fresh all-time high for revenue of $371 billion, which is great to see. Now, if we head over to the cash flow statement, operating cash flows also came in at an all-time high of $132.6 billion now. This is great to see. However, due to Google doing so much capital expenditures, their free cash flow has been flat since about 2022 now, and they've only done about $75 billion in free cash flow in the trailing 12 months because Google is putting so much money into capital expenditures. And this is also why I think that, maybe they should just cut the dividend. Like, in an ideal world, if shareholders wouldn't freak out, like, Google just cut the dividend and put that money into CapEx, or cut the buybacks and put that money into CapEx. Like, this is kind of why I find it strange that they're doing so much buybacks and dividends when they're clearly in this huge CapEx cycle. Like, just put the money over there. That's what Amazon's doing. I think Amazon is being a little bit more intelligent with cash. They're not spending so much money to buy back shares. They're not paying a huge dividend. So they have more cash to actually allocate to CapEx. They're not hampered by having to pay a dividend to shareholders, basically. So that's kind of why I prefer Amazon as well. I think their capital strategy just makes more sense to me. And yeah, but getting back to Google, their free cash flows are sitting at about 75 billion now. If we head over to Google's KPIs, we can see that Google search and other revenue is hitting an all-time high of 208 billion, and Google search revenue is also still growing double digits as well, which is great to see. Google Cloud revenue has done $49 billion in the trailing 12 months now, and if we take a look on a quarterly basis, we can clearly see that Google Cloud had a very strong quarter with a huge step change in revenue, with also $1.4 billion in revenue growth just quarter over quarter. And Google Cloud is now doing over $54 billion in revenue on an annualized basis. So Google Cloud is absolutely killing it. If we take a look at Google Cloud's operating income, it is clearly growing as well and heading in the right direction with $2.8 billion of operating income in the most recent quarter. And in the trailing 12 months, we can very clearly see that Google Cloud is experiencing massive amounts of operating leverage, and it's just heading in the right direction at a rapid rate. This is fantastic to see for the business. Now let's take a look at Google's price to operating cash flow, which I think makes the most sense to use to value this business right now due to all of its heavy CapEx. And right now, Google is trading for about 17.6 times operating cash flows, which is right around the company's long-term historical averages. So I don't think that Google is necessarily looking super cheap relative to its historical averages, and therefore I think the business is probably selling around fair value right now. I don't think that it is looking like it is offering a massive discount. I don't think that it is overvalued. And yeah, right now, I would say that Google is probably selling around fair value. So those are the highlights that I saw in Google's earnings report. Overall, I think that this was a pretty dang good earnings report from Google, and Google Cloud is obviously seeing increased momentum. Its growth is accelerating. Its operating income is going in the right direction. And I would say that was the star of the quarter. I also think that Google search is clearly not dead. It's growing by over 10% year over year. And it seems like Google's business is not being disrupted by AI or Perplexity or ChatGPT. And the company is holding up extremely well. YouTube, Google search, Google advertising, and Google Cloud are all growing by over double-digit growth rates as well. So yeah, it seems like it was a great quarter. There's nothing really concerning here, and things seem like they are great over at Google. And I don't really get all of the pessimism towards the stock right now. I do think that there is a lot of stock-based compensation going on. I do think that there is some weird financial stuff going on as well with them taking on debt, buying back shares while investing massively into CapEx. So to me, that's just kind of strange. And then in regards to the $85 billion of CapEx, I mean, Google Cloud is clearly seeing increased momentum right now. And if they can deploy more capital into CapEx to grow Google Cloud faster and meet the demand that they're clearly seeing, then I think that's ultimately a bullish thing for investors. They're deploying capital today to increase the business's profit potential in the future, which is pretty much exactly what you want as a long-term investor. So I don't think that this is a bad thing to see. And if anything, I think it suggests that Google Cloud is accelerating and that the growth is there and that the demand is there as well. So I don't know why investors would view this as necessarily a bad thing. I think that as long as they're getting good returns and the demand is there, then they should be deploying as much capital as they possibly can to capture that demand and get that return and grow the business. So in my opinion, the CapEx does make sense. But that's going to wrap up our discussion on Google. And now let's move over to Netflix. Netflix stock has been absolutely insane over the past couple of years. In 2021, it was a $682 stock. Then it fell by roughly 75% all the way down to $167. And since then, the stock has now recovered and is back up over 600%. So the people who bought the dip down here absolutely nailed it and are sitting on some pretty massive returns. However, Netflix stock is down roughly 12% since it reported earnings recently. So let's go through the earnings and see why the stock may be down. And as always, I took screenshots of what I think investors need to know. So this is from the Q2 2025 letter to shareholders from Netflix, and it says, "Our business continues to perform well. In Q2, we grew revenue 16% and our operating margin of 34% expanded 7 points year over year. Both revenue and operating income were slightly above our guidance due primarily to foreign exchange. We now forecast 2025 revenue of $44.8 billion to $45.2 billion, up from $43.5 billion and $44.5 billion. So Netflix had a really good quarter actually. The revenue grew 16%, they increased their guidance, and their operating margin expanded 7% year over year, which is pretty dang impressive. So let's continue on through my screenshots. And right here, we can see that revenue once again grew 16% in the quarter. Operating income came in at 3.8 billion. The operating margin was 34.1%, up 7% year over year. Net income was 3.1 billion. Earnings per share was 7.19 billion, which was up massively year over year. It's up something like 40%. We can also see that free cash flows almost doubled from 1.2 billion to 2.3 billion. This was a really good quarter for Netflix, and in fact, it was a record quarter for revenue and profitability. Now, in the next quarter, they're also expecting revenue to grow by 17.3%. And if we take a look at the revenue trend over the past year and into the next quarter, we can clearly see that revenue is actually accelerating right now. In the first quarter, it was up 12.5%. This quarter was 16%, and now next quarter is projected to be 17.3%. So Netflix is seeing its revenue growth rates accelerate, which is a great thing to see for the overall business and its shareholders. Then Netflix talked about their guidance for the year, where they said, for 2025, we are increasing our revenue forecast to what we talked about previously. This represents 15 to 16% year over year growth, or 16 to 17% growth on an FX neutral basis. The majority of the increase in our revenue forecast reflects the recent depreciation of the US dollar. So Netflix is increasing its forecast for revenue for this year because the US dollar is depreciating. And Netflix is a global business where they get revenues from all over the world in many different forms of currency. So when the US dollar depreciates, the revenue that they get from other currencies and other economies essentially goes up relative to the US dollar. So since they are a global business that operates internationally, they actually benefit when the US dollar declines. And that is why their revenue growth on an FX neutral basis is projected to increase this year. So the way that I view this is their increased revenue outlook is coming from something that's actually out of the business's control. And it's not necessarily a bullish thing for the business itself, in my opinion, because the increased growth is coming from the US dollar declining. And as a Canadian, I've definitely been noticing that the US dollar is going down quite a bit this year. My Canadian dollar is going further. So those were the highlights from Netflix's earnings release. So now let's head over to Stock Unlock and take a little bit more of a zoomed out look at Netflix's business. And here we can see that Netflix's revenue growth is in fact reaccelerating. It went through a little bit of a deceleration here in 2022 and 2023, but since the third quarter of 2023, their revenue has been reaccelerating and growing quite nicely once again. Netflix's earnings are also absolutely exploding right now, and they're hitting an all-time high of $10.2 billion in a trailing 12 months now. Netflix operating cash flows are sitting at an all-time high as well of $9.1 billion as of this most recent quarter in the trailing 12 months. And lastly, if we take a look at free cash flows, they are sitting at an all-time high of $8.5 billion now, which is great to see. So if Netflix had a great earnings report, it was a record quarter, a record for profitability, margins are expanding, revenue growth is accelerating, and the outlook for the year was increased, then why did the stock drop 12% after the earnings report? And in my opinion, it's simply because of how expensive Netflix stock has become. This stock is now trading for 60 times free cash flows, which is a free cash flow yield of only 1.7%. So pre-earnings, this thing was probably trading for around 65 to 70 times free cash flows. This is a very high price to pay for any business, and in my opinion, this is an extremely high price to pay for a business that's growing between 15 to 17%. I mean, 60 times free cash flows for 15% growth is quite up there in my opinion. In fact, we can go and run a quick discounted cash flow calculation on Netflix stock, and I'll show you what Netflix would have to produce to yield a 10% annual return going forward. So first off, let's say that they can continue to grow free cash flow by about 17% annually from here, which is in line with the overall revenue. Let's say they continue to buy back around 1% of their shares annually, and the stock will trade for about 35 times free cash flows, which is still a pretty high price over the next 5 years. So if Netflix can continue to compound free cash flows by 17%, buy back 1% of their shares annually, and trade for 35 times free cash flows, then the stock will compound by about 6% annually over the next 5 years. And these are some pretty bullish numbers in my opinion. Like a 35 multiple for 17% growth is still on the high end for what I like in my own portfolio. And I would still consider this a pretty expensive stock. So I think that there is already a lot of future growth baked into Netflix share price today. I think that's why the stock fell even after a great earnings report. And even after that fall, with the increased earnings and with the accelerated revenue growth, I still think Netflix stock is overvalued today. Like, let me show you. Netflix would have to grow its free cash flows by about 22% annually and trade for that 35 price to free cash flow to achieve a market average return of about 10% going forward from here. So personally, I think this is just a typical case of the stock ran a lot faster than the fundamentals. It got overheated and now it needs to cool down a little bit. And personally, I'm not a buyer of Netflix here. I think it's very expensive. And I think the business really has to deliver just to produce a market average return over the next 5 years. So the risk reward here for me for Netflix here is it's just a little bit out of whack. The stock would need to fall quite a bit for me to be interested in it. And that's my opinion on Netflix today. So now let's move on to Tesla's earnings. And boy, oh boy, let me tell you, this was a freaking dramatic report for Tesla. You guys know, if you've been watching my channel, I am not a bull on Tesla. I have been very clearly bearish on this company for a while. And let's just get into this. Now, when I read this screenshot, this is the highlights of the earnings report. This is like the first page, okay? When you read these paragraphs right here, I want you to sit and think about the tone that Elon Musk and Tesla is using, okay? Like, this is the first page, all right? So let me read this. Q2 was a seminal point for Tesla's history, the beginning of our transition from the leading electric vehicle and renewable energy industries to also becoming a leader in AI, robotics, and related services. We continue to expand our vehicle offering. The energy business is more critical than ever. So those are just the highlighted segments that I put right there. But when I read this, it comes across like Tesla had one of its best quarters in the company's entire history. They're saying this was a seminal point. We're expanding our offering. The energy business is more critical than ever. So that's how this reads to me, all right? Now let's go on to the actual financial summary. And here we can see that automotive revenues in total were down 16% year over year. Energy generation and storage revenue was down 7%. Services and other revenue was up 17%. This is the only thing that was up, by the way. The one thing that was up. Total revenues are down 12%. Total gross profit is down 15%, so the gross margin is declining. Income from operations is down a whopping 42% year over year. So the operating margin is falling off of a cliff. Adjusted EBITDA is down 17%. Net income is down 16%. Operating cash flow is down 30%. And free cash flow is down 90 freaking percent. This is terrible. These numbers are absolutely terrible. Tesla's automotive business is declining massively. Its energy business is declining. Its margins are contracting. Its profitability is declining. Its free cash flows, they're gone. Like 90% decline to free cash flows. That is wild. So the numbers are just straight up terrible. This was a terrible financial report. Moving on to the next screenshot, this says total revenue declined 12% and was impacted from the following items. Decline in vehicle deliveries, lower regulatory credit revenue, reduced vehicle average selling price, decline in energy generation and storage revenue due to lower average selling price. So when I read this is a decline in vehicle sales, and they also reduced their average selling price per vehicle. This is Tesla basically offering a sale on their cars. They're lowering their car prices. And despite them lowering car prices, they're still selling less cars on a year-over-year basis. Now, this suggests to me that Tesla does not have pricing power because they're having to lower the price of their vehicles to try and sell more vehicles. And they're still not even achieving that. Their sales are still declining. So yes, this is what a company without pricing power looks like. And this ultimately suggests to me that Tesla does not actually have a moat. Now, moving on to the next screenshot, this is their auto business and storage deployment. And we can see that their auto total production is flat year over year. This is really interesting to me because their Model 3 and Y deliveries are down 12% and their other model deliveries are down 52%. Total deliveries are down 13%. So Tesla is selling less vehicles, but their production is remaining flat. So they're producing the same amount of vehicles, but they're selling less. And the only logical outcome from that is their inventory is going up. And their inventory is up 33% year over year. So what this all looks like to me is Tesla doesn't want to slow down production, but they're selling less vehicles. So their inventory is bloating. And that's why they're having to sell cars at a lower price. But even though they're selling cars at a lower price, they're still selling less vehicles. This is not a good situation to be in. This is a bad situation for Tesla's auto business. This suggests to me that profits are probably going to continue declining, average selling price is going to continue to decline, and potentially even sales will continue to decline. Storage deployed also only grew by 2% year over year. Like, nothing about this looks good to me. Nothing about this. Now, this next screenshot shows us Tesla's market share in its key regions. This is China, Europe, and North America. Well, the US and Canada. And in every region, Tesla's market share is declining. And in my opinion, this is another indicator that Tesla does not have a moat. And I've talked about this in previous videos, but Tesla is losing to BYD. BYD is eating Tesla's lunch in every market that the two companies operate in or can sell vehicles in. BYD is winning. They're straight up winning. Tesla's losing. This company, in my opinion, doesn't have a moat, and its fundamentals are all going the wrong way. Now, what's interesting is when you head over to X, this is what Elon Musk said after the earnings call. Extreme execution is needed, but a valuation of $20 trillion for Tesla is possible. $20 trillion. Okay? After an earnings report like that. Then this next screenshot, this is actually a bearish screenshot, but this said, Elon Musk says 50% of Tesla owners that could try full self-driving have not even tried it once. And then Brandon Flash said, many people don't want it. I know it's hard for Tesla pumpers to accept. So think about that. 50% of Tesla owners who can try full self-driving have chosen not to even try the product. And this was also one of my bearish points towards Tesla is, me as a driver, I wouldn't pay $99 per month for full self-driving. I am happy to save $100 per month and just continue driving myself everywhere like I have been my entire life. $100 a month is a large expense for your average consumer. So unless this comes down significantly, I wouldn't pay for it. And then I personally also still have a trust issue with putting me and my wife in the hands of a vehicle, like just in the hands of a computer. It just doesn't feel comfortable to me. So I'm going to continue driving on my own until I'm forced to not. And I'm definitely not paying $100 a month to do that. Then after the report, Cathie Wood also came out and said her Tesla price target is $2,600 by 2030, which would put Tesla at a market cap of about $6 trillion within the next 5 years. That is just absolute insanity. I have no idea why anyone listens to her anymore. It's just crazy. Then another person on X said, is Tesla about to have its NVIDIA moment? And then they showed a chart of the two. And this person is basically insinuating that Tesla is about to absolutely skyrocket and moon, and the stock is going to go up massively. I think all of this is just a clear indication of how much speculation, how much pumping there is on Tesla stock, and just how much, in my opinion, absolute delusion there is. There is nothing attractive about Tesla's fundamentals right now. If you take a look at its revenues, like the company's revenues have been declining now for 2 years, and the revenues are going the wrong way. Gross profits are declining, and they're consistently declining. If we go to the KPIs and we look at the total automotive gross profits, the automotive gross profits have been cut in half over the past 3 years, and the gross profit margin on the automotive business is declining rapidly. But every time I point out how ridiculously bad Tesla's fundamentals are now, the rebuttal is that this company is not an automotive business. And okay, I can buy into that. All right, I can buy into it. They're working on Optimus, they're working on full self-driving, and all of it. My issue has always been that you have to understand that when you're investing in a company in the stock market, you can already pay for all of that future growth. That's just how it works. The stock can become disconnected from the existing business. And in my opinion, Tesla at a $1 trillion valuation today, which is what it's selling for, is not a reflection of what the business is today. It's already a reflection of what the business will be in the future, if everything works out. And that's where the risk is. Like if Tesla was valued at $50 billion today, it would be a totally different story, because then it's not pricing in the potential execution of Optimus full self-driving working out. But this thing is already selling for 178 times cash flows. And when you're buying a stock at 178 times cash flows, you're already paying for so much of that future growth. And these are products, by the way, that we don't know if they're going to work out. I don't know how profitable full self-driving is going to be. I personally think it's going to be a commodity. When you have Waymo and full self-driving and other companies are working on full self-driving, like 10 years out, if 15 companies achieve full self-driving, then what gives Tesla pricing power? What gives Google Waymo pricing power? So I'm bearish that full self-driving vehicles are actually going to be profit-making machines with high margins because I think they're going to become a commodity long-term. That's just my opinion. So that's a risk. And then there's also the risk of Optimus not really working out, or maybe other companies building robots. There's a lot of companies building robots. Amazon's building robots. So I don't know if that's going to be a highly profitable business venture either. And that's the risk, because you're already paying for those products that could potentially not working out. That's just how the stock market works. I understand that Tesla is not a vehicle company. I get it. But man, you're already paying for those future products to work out, and that's the risk. So that's my opinion. I think Tesla's current business fundamentals are terrible. And I think that the stock is already pricing in its future business lines to succeed. And then if they don't, then this stock is going to go nowhere but down over the long term. So that's my ramble and spiel on Tesla. I think it's a very speculative and risky stock, and I am not touching this thing with a 10-foot pole. All right, now moving on to the next discussion. This one's a funny one. All right, so this is American Eagle. Over the long term, well, over the past year, this stock has gone down a lot. If we want to take a look at the actual percentages, it's down about 50%. But over the past month, this stock has gone up roughly 20%, 22%. The reason the stock has gone up is because they did a promotion with Sydney Sweeney. She is like the it girl right now. Everyone seems to be in love with her. And she did this big promotion with American Eagles wearing their clothing. It was a pretty, I would say, non-woke commercial. I'm sure everyone has seen it by now. And that caused American Eagle stock to go up 21%, and the company gained $200 million in market value. What this has led to is people on X and social media now saying, we need to get Sydney Sweeney to go and promote Hims. We need to get them to go and promote United Health. And I think what this is going to lead to is a speculation around what company is Sydney Sweeney going to go and promote next? Or how can we get her to come in, do an advertisement with our company because it will cause the stock to go up? Like, that is the point of the stock market cycle that we're in right now. It's getting mad out there, all right? It's getting freaking weird again. This is starting to remind me a lot of what we were seeing in 2021. And I'm getting big 2021 vibes in the overall market right now. To double down on this, all right? Open Door. Randomly, out of nowhere, this company started to become popular on social media again. This was like one of the COVID darlings. You know, I believe it was a SPAC. It was a SPAC. And in 2020, they SPAC'd. The stock went up like 200 something percent, 232%. And then it fell 98% from its peak. So it basically was a total loss for shareholders. But now, for some freaking reason, this stock was up something like 820% within a month. Then it started getting all the hype on social media again. People were saying, you know, this company is gonna blow the F up. So let me show you some screenshots that I found here from social media, all right? So this person, Carp God, said, I want everyone to take a close look at the image below. Open plotted against the 30-year US Treasury. They essentially have moved in the opposite directions. Now add in that Trump is going to take away cap gains on real estate, restructuring, and efficiency improvements, positive EBITDA and profitability boom. So basically, this person's entire investment thesis is that Open Door stock has had a negative correlation, an inverse correlation to the 30-year US Treasury yield. Therefore, their thesis is when the 30-year Treasury yield, the interest rate, drops, Open Door stock should absolutely moon. That's the level of DD we're seeing on social media right now. All right, that's crazy. Next one, Open. Zoom out of the chart. Open Door is insanely undervalued, still trading near the bottom. Even those who bought at $5 are now sitting on what could become a 10x return. Life's an open door, money's an open door, everyone's invited. This is the type of stuff that I'm seeing on social media again. This is 2021 vibes in a big way. This person is literally saying that Open Door is insanely undervalued because of how low the stock is relative to its history, because it's still down 90% from its all-time highs. That is no way to analyze a stock. That is the most poor analysis you could possibly do. If we want to do a real analysis of Open Doors fundamentals, let's go and take a look at their most recent financial report. Here is their income statement. Their revenue was down year over year. It was basically flat. Gross profits were down something like 15% year over year. The company is losing money on its operations. It lost $56 million, and its share count is consistently growing, and it grew by something like 8% year over year. So the share count's growing, the business is losing money, its gross profits are going down, margins are declining, and revenue is declining as well. If we take a look at their cash flow statement, they lost $280 million in the first quarter alone from their operations, just in one quarter. Their CapEx was low at only $4 million, and how they are funding the business is proceeds from non-recourse asset-backed debt of $576 million. This company is very much so losing money, lots of money, and it's taking on lots of debt to continue funding the business. So let's go over to Stock Unlock now, and we can see that their revenue peaked at $17 billion in 2022. It's all the way down to $5.1 billion now. If we take a look at their operating income, it's always been negative. The operations have never made a GAAP positive profit. If we go to cash flows, we can see that their operating cash flows are negative $700 million over the past year, so losing hundreds of millions of dollars. And if we take a look at their balance sheet, we can see that their cash position has been declining rapidly, and they have about $560 million of cash left. So this company is very clearly losing cash. Its profits are not there. It's losing a lot of money. Its revenues are declining, but people are hyping the stock up now and saying it's a 10x opportunity. You got to buy it. It's still undervalued because the stock is down. And there's more examples. Beyond Meat has been rallying. Oatly has been rallying. Skills has been rallying. Like, these are the names that were popular in 2021, and now they're coming back. So I'm definitely getting 2021 vibes, and it's not necessarily the best feeling, especially when a lot of stocks in the S&P are getting very expensive. The S&P itself is getting very expensive, and yeah, I think people should just be careful out there. That's the moral of the story. I think people should be careful. I think people should always be focusing on fundamentals, and don't take your eye off the ball. Now, with that being said, I'm not pulling money out of the market. I am still basically fully invested as I can possibly be. My cash position is very low. But the reason that I remain fully invested in the market is because I am buying businesses that are not part of the S&P and businesses that I think are truly undervalued relative to their fundamentals. I have been very open about this, but I have been finding more and more value in the international markets. And in my opinion, even if the S&P falls 20%, the international markets will probably do just fine. So what I'm trying to say is my investments now and my portfolio is becoming less and less tied to the US markets and whatever happens in the US. Because I think that the risk of the US markets is going up simply because price is getting insane. Yes, the fundamentals of the US businesses are the best in the world, but I don't think that you should be willing to pay an infinite price for strong fundamentals, which is kind of the mindset now. If a company has strong fundamentals, then screw it. 60 times cash flows, easy. 80 times cash flows, why not? You know what? 170 times cash flows, whatever. Fundamentals are good. Like, that's the mindset I'm seeing. And that's not what makes me comfortable. I think that increases investment risk massively. I think price is very important. There's a passage of The Intelligent Investor that literally says, your margin of safety is 100% dependent on the price you pay. You have a margin of safety at one price, you don't at another price, and there's huge risk at another price. So price literally determines the amount of risk you're taking with a business. And when the prices are high, you're taking a lot more risk. So that's why I've been moving away from the US markets, just because I think prices are getting way too high. I think the markets are getting extremely crowded, and now we're also seeing crap like this happen again. So yeah, that's why I've been exploring the international markets. I'm finding absolute gold in the international markets that are very cheap. That's kind of my ramble on what I've been seeing out there. So let's move on to the next topic of discussion, which is Mercado Libre. This will be a very quick topic. It's just one screenshot. So I saw this pop up on social media the other day as well. I'm just going to read the underlined segments, but it's kind of just an update with the business, okay? So if we zoom in a little bit, this says, Mexico and Argentina are performing solidly. Total industry hot sale activity was up 24% in Mexico and 63% in Argentina. Lower fee shipping minimums announced in June in Brazil translated to strong app usage for the month and prompt us to raise our Q2 2025 and full year 2025 MELI Brazil GMV expectations. Argentina continues to post better than expected inflation numbers, which is supporting improved economic growth and a robust 7.7% GDP growth in April. Argentina is far and away MELI's most profitable geography, with 47% contributions to margin in the first quarter of 25. In Mexico, this year's hot sale saw gross merchandise volume rise 24% year over year, overall with goods sales rising 26.5% and services up 7.3%. This marks an acceleration of 15% from 2024. Mercado Pago was the payment method used for 20% of hot sale transactions versus 17% last year. Nubank surprisingly saw a 1% point decline to 13%. MELI reported 4.5 million units sold during the 2025 hot sale in Argentina, which was a record. MELI saw flat aggregate web and app usage from May to June 2025, while peers were down. Shopee was down 4% and Amazon was down 7%. On the fintech side, Mercado Pago was a clear winner in Brazil. Pago daily active users rose 8% quarter over quarter, while rival PicPay actually registered a slight decline in daily active users. It was only a year ago that PicPay was leading Pago in daily active users, and now Pago has 20% more daily active users. In Mexico, it was another good quarter for MELI, with shopping daily active users up 16% quarter over quarter, topping Timo and Amazon up 7%. So basically what all of this is saying is that Mercado Libre is continuing to dominate the competition in South America. Mercado Libre is an absolute beast of a company. There is no other company that I have seen with a revenue growth chart like this. Like, just look at this. This is a ridiculous amount of revenue growth. This is a 40% compounded annual growth rate to revenue for 20 years. And even when you zoom in, the revenue growth rate actually accelerates 52% CAGR from 2018. This business is an absolute freaking monster. It is winning on all fronts. It is kind of like an ETF of businesses down in South America, and every business is exploding. If we go to the KPIs, we can see that fintech revenue is absolutely exploding. It's up to 9.4 billion, compounding at 57%. And in the most recent quarter, they had another record quarter, $2.63 billion of fintech revenue. Their total payment volume is growing by 40% annually. That is its compounded annual growth rate. It's acquiring total payment volume, compounding by 30% annually. Its gross merchandise volume is compounding by around 25% annually. So this is not just an e-commerce company. This is a fintech giant. It's an advertising giant. It's an e-commerce giant. It is like the Amazon of Latin America, but also with a fintech and banking business. And all of its business units are exploding. Now, at the same time, this business is trading for a market cap of 121 billion, which is a price to free cash flow on my adjusted numbers of about 24. So a 24 price multiple for over 30% annual consistent growth, I think is an absolute steal. This is why Mercado Libre has become one of the largest positions in my portfolio. And I do think that the stock is still undervalued personally today. So I'm going to be following this one. I am happy with my position right now, so I haven't been adding to it because it is one of the largest stocks in my portfolio now. But I'm definitely going to be watching this one's earnings and making a video on the earnings when they come out. But all signs are saying that Mercado Libre should have a really good Q2 report, and I can't wait to see the numbers. I think that this is just a beast of a business, and I wanted to update you guys with what I have been seeing there. So now let's move on to the final discussion in this video, which is just talking about a couple of comments that I got on my previous video that I think are just really cool. So this first one comes from Tyler McGinnins, and he says, "Congrats on the wedding. I suffered the same missed gains on Meta, underestimated what was considered expensive." Then I said, "Thank you so much. My mistake on Meta was not swapping to focusing on operating cash flow and price to operating cash flow when the company was clearly going through a massive CapEx cycle. In hindsight, if I looked at operating cash flows instead of free cash flows, then I would have just held on. It's a lesson I still try to apply to my investing today." So this was in regards to me talking about me selling Meta a little bit too early. And I'll show you exactly what I did wrong here. So I was buying Meta all the way down. My lowest buy on Meta was somewhere around like $92, okay? So I was buying the freaking dip on Meta. But then I was selling around $250 per share, which was right around here. So I made good money. Don't feel bad for me. I made good money on Meta, but I definitely sold way too early. Now, the reason I sold was because I was taking a look at Meta's price to free cash flow ratio. So let me show you what the price to free cash flow ratio looked like during this time. So let's zoom out and we can see that it got all the way down to 10. So Meta's price to free cash flow was ridiculously low at this time. And then as the stock was rebounding, its price to free cash flows were getting back up to 31. And this is where I was like, you know what? The stock is not really looking that cheap anymore. I'm going to exit. I made good money. I'm going to get out. But what I failed to do was realize that Meta was going through a massive CapEx cycle like Google, Amazon, Microsoft, all these companies are still doing to this day. And if I simply swapped to the price to operating cash flow, which is what I'm doing now with all these companies, take a look at how different the story was. So right here, we can see that Meta's price to operating cash flow was 5.5. Price to free cash flow was 11.3, okay? Now, when Meta's price to free cash flow got back up to 31.4, where I was saying, hey, maybe the stock is getting expensive again, the price to operating cash flow was only down at 11. Now, Meta's average price to operating cash flow over the past about 7 years is 16. So while the price to free cash flow was getting high, the operating cash flows were still quite low. It was still selling well below historical averages. And if I simply looked at this metric instead, and if I knew back then to swap and to focus on operating cash flows when a company is clearly going through a short-term CapEx cycle, which subdues free cash flow and increases your price to free cash flow, then I would have held on to Meta much, much longer. And I would have been able to ride it much, much higher. And I probably would have sold around March of 2024. And if we go back, that would have led to me producing gains of maybe 400%. So I definitely sold too early. And my mistake was not focusing on the operating cash flows when they were going through the CapEx cycle. And I think that's a good lesson to learn. Now, the next comment was, I sold Palantir in the $50 per share range. I genuinely believed that it was a prudent sale, and I still believe so today. Of course, Mr. Market has agreed with me thus far. Either way, I think you're correct that sometimes it's prudent to sell. As for Buffett's second reason to sell, it is so difficult to know exactly when hype-filled growth stocks are truly overvalued. Then I responded, I agree completely. It's challenging to know when to sell due to a stock getting expensive. It also plays with your emotions because the stock can continue running higher even though it's already overvalued. There's just no way to perfectly time it. What I do is ask myself, before I sell, if I would feel more regret, A, selling and having the stock go up, or B, not selling and having the stock go down. Then whichever path I choose, I live with it and I don't look back. So this is what I actually do. So whenever I sell a stock, if I think that its valuation is getting insane, I try to, well, before I sell, I ask myself, in which scenario would I feel more regret? If the stock continues to run without me, or if I don't sell and the stock goes down? In most scenarios, I personally would feel more regret if I knew the stock was massively overvalued and I didn't sell and then it went down. Because I know I would be like, just for my own investing style, I know I would be like, well, dude, that was a clear sell. Like the stock was clearly overvalued. You should have just let go of it. So I lean towards selling when I know, based on fundamentals, that the stock is just way too high. And then once I make that decision, I just live with it. And I never look back and I don't let my emotions cloud my judgment or, get this FOMO like, oh, I sold, now the stock is up 20%. Like, why did I do that? I'm such an idiot. You just got to live with your decisions. And you have to know that nothing is predictable when it comes to investing. Like Palantir. That stock has been so expensive for so long, it makes no sense why it's continuing to run so much, but it just is. And that can happen. So you're never going to time the market perfectly. And what I do is I just try to base all of my investments off of the fundamentals and value. And then if I know that I'm sticking to my principles and I'm making my decisions based on logic, rational decisions based on value, fundamentals, then whatever the market does is fine, because I know the market can be irrational. So if I am staying rational and that's what my decisions are based on, then I just live with it. And I know that I'm doing everything I can. And I also know that the market is unpredictable. So there's no reason getting upset about it. There's just no reason. It's not productive. And that's where I've come to get in my investing. But this video is getting very, very long, so I'm going to wrap it up there. If you enjoyed the video, please remember to leave a like on it, and I would love to hear what you guys think about this video and the longer form content that I have been producing lately. And if you're interested in getting access to my portfolios, all of my buys and sells, all the international stocks that I'm buying, my Discord community, and dozens of extra content from me, then consider checking out my Patreon. It's only $15 per month. The Patreon community has been absolutely loving it. People love it over there, and I think that you will too. So consider checking it out if you want to see my portfolio, my performance, and everything that I do over there. But with all that being said, thank you all so much for tuning in. As always, I truly do appreciate it, and I hope to see you all again in my next video.